Good evening. This is Ken Long at Tortoise Capital with a review of the weekend trading report for August 4th, 2017. We have a market that is in bullish, quiet conditions that is favorable for long side trades, both day and swing. Looking back at the annual NDX or NDX 260, we are overbought with a score of 100 out of 100. On a 10-day basis, the short-term look back, we are also overbought at 100 out of 100. Considering the market mosaic, price with respect to the 200-day moving average is green bullish at 6.14%, meaning that we are 4% above the boundary to sideways markets. This is favorable for the long side. The slope of the 50-day moving average is white neutral at 0.3. ADX 14 measurement of the strength of trend is weak at 14.3 with bulls in charge, so slightly upside bias. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off. The current reading is 1.033, so we are into risk on conditions, meaning that riskier assets are favored. We take that score of 1.033, look back 5,000 trading days, find the average and standard deviation, and compute the risk Z score, which is how many standard deviations above or below average that risk Z reading is, given the long-term look back. That reading is risk Z is at 0.27. Here is a 90-day histogram of that indicator. You can see that we had a recent high almost at 1 sigma and is now coming back towards the zero line. That still favors long side positions, but new swing positions should be entered carefully and with risk management emphasized. Open positions that are in the money should be protected with profit preservation stops, and if that reading goes below the zero line, we are beginning to adopt a short side, 1-day short bias. In the blended monthly rebalancing, you can see the leading candidates from the different ETF populations, featuring technology and international assets for the most part. And then the current leaders as of August 4th, based on the closing price. In ETF 2, our weekly asset allocation model with relative strength, the theoretical exposure of the model is at 100%. And the model portfolio itself will be at 100%. So all 10 of the major global indexes are above their 4-month moving average, and this is favorable for exposure in the markets for the rest of the week ahead. Page 2, you see a detailed breakout of ETF 13 and 32 using the blended monthly rebalancing lens. I like to look at the 1 week and 1 month performance to look for red and green. Green indicating that it is outperforming its peer group significantly. Red meaning it is underperforming its peer group significantly on that time period. The leading candidates in ETF 13 you can see are emerging markets, technology, and the Euro-Asia blend. And diamonds, the Dow 30 with a 1 week score of 0.86 is in the green, meaning that it is outperforming the other elements of the ETF 13 significantly, as is Latin America. Latin America has been dominating on both 1 week and 1 month, but has been average on 3 and 6 months, so this may be the beginning of a macro swing move in Latin America in the weeks ahead, and we'll keep an eye on that. U.S. mid caps and the U.S. small caps are both suffering in performance against their peer group in all measured time frames. So generally weakness in the U.S. except for the large caps and tech. ETF 32, the same patterns are emerging. You see now the emerging markets index in China and the BRIC countries and the Euro 350 dominating. The Euro 350 is exceptional on 1 week, and so there may be some more room available on the upside in Europe, and that's an alert to our currency traders as well. Laggards in ETF 32 include agriculture, commodities, and the energy sector. In ETF Max, we're looking at the same looking through the same lens, a blended monthly rebalancing, but at a population of about 500 liquid ETFs. You can see some leaders on the 1 month category there in China, in solar, and in rare earths. In the S&P 500, we have a couple high quality momentum plays in potential here with FMC and Best Buy, Rockwell Collins, and Xylem. These are green across the board, and so their outperformance may suggest more momentum to the upside is available, or it may be that that's such an extended stretch that preserving profits and playing for uh, a reversion to the Bollinger Band mean may be available. Again, Regeneron Pharmaceuticals has been a relative strength leader, but has been underperforming on 1 month and exceptionally underperforming on 1 week. And so that may be the collapse of a former high flyer. And there may be some downside momentum available there, or a buy on dips opportunity for what used to be a leader. This is the market health check. The vertical blue lines represent 10, 20, and 30 days worth of look back, along with 40, 50, and 60. The heavier blue lines are 30 and 60 days of look back for convenience. The solid red lines are support levels that used to be resistance levels, and which, if the current price levels crack, become target levels on the downside. That's our price ladder to the downside. The 10-period regression channel is basically flat with price right on the midpoint of that, so fairly valued on the 10-day look back. The 30-period regression channel, lagged by a day, is sloped to the upside. The sine wave looking line in the middle of the chart, featuring the red, green, and blue dots, is the moving slope of that 30-period regression line. And wherever that crosses the zero line is when the slope began to get positive on the 30-day regression line. Slope of the 30 is a health of the trend indicator, and you can see that the previous two humps that are in the green, by consulting the index on the left, you'll see that that was the slope that was achieved until that upward trend began to decay. And if you read down and look at the price action, you'll see that after that green dot was achieved, there was some weakness introduced into the market. The current reading on that slope is now at the same level as previous pullbacks achieved. And so this is a place where we are prepared to preserve the gains made from the last swing trades and to be ready for an orderly pullback to support levels, as happened the last two times a slope of this level was achieved. When that slope rolls over, it doesn't necessarily mean that the price is going to collapse. It's just no longer climbing at the same rate that it achieved before, and it may simply be slowing down, and you've seen that in a couple spaces there. If you look at the percent price oscillator now, you'll see that it's above the zero line, and but the jaws of those two lines have closed, and this suggests that the last leg up is over and that it's paused or pausing at a natural support level, and this reinforces the notion that a return to the Bollinger Band mean or the far side of the river is not out of the ordinary. That would be the least surprising move. However, it has not failed further in the last 10 days, and so a base may be put in. So I put the market at a critical state near its all-time high. It has failed to fail, and it can be moved in either direction up to 5% without it having a significant long-term effect. So there's plenty of room for short-term traders here to take advantage of the increasing volatility that we see creeping in. Now, when the risk Z begins to decline, that suggests short-term volatility is beginning to rise, and so one-day adverse moves are not out of the ordinary and don't jeopardize the bull, but provide short-term trading opportunities. The next look is at the ETF2 model and the 10 indexes of the world market model there. The ETF2 model are all above their 4-month moving average, so they're all on buy signals, and that puts us at a theoretical allocation of 100% invested, 0% cash in that model. Um, the EFA strength rating is 63. The SPY's rating for strength is at 56, and so this places the global equities in a stronger position than the U.S. So right now, global is leading the U.S. Inside the U.S., the strength is in small caps at 61, tech at 59, large caps at 56, and then weak mid caps at 50. The two strongest sectors in the world market model right now are emerging markets and the Euro 350. The two weakest segments are U.S. small caps, U.S. mid caps and U.S. large caps. Looking at the S&P sector spiders, the 9 sector spiders, we see real weakness in materials and industrials. So in the event of a weak market and weakness in those sectors, the tactical trade is to find the weakest performing companies and to be short intraday and to look for one-day gains. Healthcare is also weak, and the remaining sector spiders are above the database average. In the world market model itself, in the center, we can see the U.S. market is below average for mid and small caps generally. Large caps are above average across the board. All of Europe is strong, and some of the countries are exceptionally strong in the green. Asia is a mixed bag of strength in the green and weakness in the yellow. The sectors of Japan and Asia less Japan are above average. Emerging markets in Mexico are very strong. Latin America and Brazil are strong, only Canada showing weakness in the Western Hemisphere. In the alternate asset classes, corporate bonds are exceptionally strong, and weakness in the commodities in both energy and agriculture. Looking at the world through the ETF2 lens, our weekly asset allocation relative strength model, what I look for are those symbols that are green in the strength and white in consistency. Consistency is a 10-week moving average of strength. And so a symbol that is green on strength is strong this week compared to its peer group. But if it's white in consistency, then it's not been strong long enough to achieve a green. So that could be an early sign of emerging leadership with green and then white. Alcoa is green and yellow, so that's had a short-term burst. Now that's an anomaly considering Alcoa is in basic materials and industry, and that suggests that there's some company news that may have more momentum to develop here, so Alcoa will be on my short list to monitor. At the bottom of the stack, you see some emerging strength in home construction, China 25, Singapore, Taiwan, and then emerging markets. So that's emerging strength with more room to grow. I'll go back and look at Pulte Homes because that was an outperformer on the S&P 500 and the BMR. And if the home building sector in the U.S. is strong and Pulte Homes is strong, then that sets up a logic chain between the market, the home building sector, and Pulte, and that may provide an opportunity for short-term gains tomorrow. Next is ETF liquidity. This is simply ranking the symbols by their average daily dollar volume. Everything on this list is liquid enough to trade intraday with reasonable slippage. And see, technology has now moved into second place for average daily dollar volume above the small caps, and that's part of the resurgence of interest in technology. Shifting to the daily report now, no signals in channeling and overreaction. You see the 10-day maximum pain candidates. These are the ones that have lost the most on a percentage basis from their 10-day high. And there are a handful of swing setups in channeling. 5 days down, Triple Screen has a few in the ETFs and McDonald's. 551W. So we'd be buying second day momentum in basic materials, real estate, DuPont, Microsoft. In the auto framer, our old reliable Win, Metals and Mining, and DuPont are all testing out better than 2 to 1 on reward to risk just using mechanical entries and a test of the 10-day high. All three of those are exceptionally good swing candidates in terms of normal swinging movement. 30-day, or I'm sorry, the Dow 30 tactical summary, only one channeling and a triple screen. There's only one symbol test out better than 2 to 1 on the auto framer. This is not unusual when we are very near 10-day and annual highs. There's not enough pullback to create that tradable moment. However, this does set up the possibility for breakouts to the upside to all-time highs with no resistance, but also a critical state with a return to the Bollinger Band mean, which is a 2 or 3% move in the markets, which would not be unusual. Those symbols that are highlighted in red were the one-day percentage losers from Friday. Those in the green were the one-day percentage winners that are more than one standard deviation above or below average compared to their peer group. Those symbols that are in the red under price change are ones that were exceptionally large losers on a percentage basis over those time periods compared to the Dow 30 peer group. The ones in green are the ones that are exceptionally outperforming, and those numbers reflect the percent gains and losses during those look-back periods. Under the NDX columns, you'll see where they are on a scale of 0 to 100 for those look-back periods. Anything that's 100 or better gets highlighted as green to let you know that it just is at or near its breakout point for that look-back period. And you can see that both Goldman Sachs and Home Depot broke out to new highs in the 10-day period. ETF 30, the same lens, but looking at those 30 ETFs, a couple channeling candidates. Metals and mining frames out at 2.7 to 1 on the auto framer. A handful of frog quality numbers better than 3. 2 RSI 2 numbers less than 10. You get to a single digit number and it gets highlighted when there's been like a 2-day washout and it may be ready for a gap down and then intraday reversal. So the RSI 2 coming from the work of Larry Connors gives us some insights into possible short-term trading opportunities in the next day. Let me come back and just look at the inverse VIX XIV. I want you to notice that the price change from one month out to 12 months has been exceptional and in the green. Over the last 12 months, it's gained 202%. That puts it in the green. But its 10-day number is down minus 1.7. So there had been a slight pullback on 10-day, but it looks like it recovered on Friday. So this might be the case again where volatility, buy on dip opportunities are there. So as always, that will be on our short list to buy intraday. Brazil is in the green on 10 days and 1 month, and this is consistent with what we saw with the ILF beginning to emerge as a leader among the ETF sectors. And so Brazil, as always, will be on our short list for intraday. You'll see it's slightly stronger than its regional ETF ILF. ILF was strong on 1 month, but just above average on the 10-day. So Brazil has a slight strength advantage, relative strength speaking, over Latin America. So this is the new daily pinch and stretch report for the Dow 30 and the ETF 30. In the first two columns, most positive Z stretch and most negative Z stretch, we're looking at those symbols among the ETF 30 and Dow 30 that are the furthest distance on a percentage and a Z score basis from their own 30-day Bollinger Band mean. How far are they from the center of the river? This one-day stretch offers either an opportunity for a second leg up or a reversion to the mean trade back to the middle of the river. And so we'll investigate the ones that are highlighted in green or would have been highlighted in red if the Z-score was less than 1. So we will at least be looking at the top 4 in column 1. The percentages just tell you how far that move has been. The Z-score is adjusted for its own volatility and performance And so that's where the variation comes from. I've included the S&P, the Russell 2000, and the US Dow 30 as a point of reference so you can see what these different elements of the market or market indices are doing and how different companies can be from the broad markets. The third and the fourth column are measurements of the size of the standard deviation that creates the river. So we are interested in exceptional performance here. Either exceptionally wide, and that would be Boeing and Verizon are both, their pinch boxes have expanded beyond 2 sigma. So this, you only get there by having an extraordinarily strong 30-day move. So that's a candidate for either continued momentum or a reversion to the mean trade. And the highlights tell us that that's a high priority to plan and prepare. In the fourth column, the most compressed pinch box, those highlighted in the red, have a standard deviation that is less, or it's more than 1 standard deviation below average, meaning they are exceptionally compressed. You only get that when you have an unusually sideways 30-day quiet channel, and so these become candidates for framing for our Z3 pinch breakouts. The bottom section shows daily super pinch candidates, and this is a subset of the compressed pinch box. To get here, you have to be both compressed on the size of the river and all 4 regression lines inside the pinch box, which suggests for a brief moment that everybody agrees what fair value is, and it'll stay there until the traders begin to move it. So these are very high priorities for framing 1-day breakouts for Z3 super pinch, which could very easily lead to a swing trade and then ultimately a position trade that lasts days, weeks, and months. And so this is a way to get them early before they start moving. We do not have a directional bias. When we trade these intraday, we're looking to trade them in the direction that the market is moving. So if we saw the market failing and we saw a super pinch also failing, we'd be inclined to take it in that direction. The auto framer lists the symbols that are more than 2 to 1 on a mechanical entry that takes out yesterday's high, using yesterday's range as the risk for execution, and then computes the distance to retest the 10-day high. And if that's better than 2 to 1, they're highlighted in this report. We only have 3 in the stack right now: Win, Metals and Mining, and DuPont. We also, so we saw them before on the summary report, and this gives us the standard framing prices to construct our 1-day trade frames. The regression line fractal framework is measuring how many how many ATRs above or below the RL270 price is currently residing. So for swing trading candidates, this represents the opportunity to take advantage of anomalies between short-term price and long-term fair value. As an example, Nike under Dow 30 is 5.36 ATRs above its own RL270. So this is the bottom shelf in the red are the ones that are tending to be relative strength leaders. Not surprising to see Boeing, Verizon, Intel from technology in that stack, because we've already seen the strength in technology and Boeing. The ones in the top shelf in the green are the ones that are the most number of ATRs below their 270, so these would be considered value plays, and we would be looking for a return to the RL270, and we could use the reward to risk ratio to check that out. Only Cisco looks tradable at a almost 3 ATRs below its RL270. This report shows the daily squeezes, symbols that are ready for a large 1-day intraday pop. And so it makes it to this report if yesterday's range was small compared to its range stat. And so if it takes out yesterday's high and using the range risk as the unit of risk, we have a significant large pops available to get the range stat move. So there's a couple candidates on here that we like that we would be framing anyway. So we'll be looking for sure at diamonds, um, EFA, emerging markets, and XLF, the sector spiders. In the market mosaic, in the upper left-hand corner, we're looking at the 30-period regression line and the 30-period polynomial regression line. You see it sloping upward. The crossing of the regression line simply means that it's in a pause condition. The chart number 3 below it shows a moving slope of the 30-period regression line and its own 10-period moving average. It's still strong and it's ahead of its moving average, so this is an upward bias. Chart number 2 shows a 180-day look back, and you can see the sine wave action of the 30-period regression line, and you see how smooth that travels. And what we look for are crossovers of the 30-period moving average slope compared to its own 10-day. When that happens more than one standard deviation away from the mean, then we're looking at potentially a long-term change in market condition. In the chart number 4, that's also a 180-day look back. You can see that there are some when those crossovers outside of one standard deviation occur, there are changes in market condition that are observable in that chart. So I really like that indicator in chart 2 as a health of the market trend. Market mosaic, page 2, charts 5 through 8 are simply additional measures that support swing and position traders to describe market conditions and are of less interest to day traders. The last chart to talk about today will be the z-scores of the 3 regression line slopes over the last 180 days. So these are normalized by z-score. So we're looking at the 10, the 30, and the 90. The 90 is in red, and it is above it's above the 0 line and improving. So the long-term strength of the market is still gaining. It is still a strong bull, excuse me. The fact that it's inside the plus or minus 1 SD says the market is not overheated. It was overheated about 3 months ago, but it has cooled off without collapsing and is now postured for another leg of long-term gains to the upside. The 30 is above the 0 line and approaching 1.0. So shorter term, this market may be overheated as we've seen, and a pullback to the Bollinger Band mean would not be unusual. The RL10 is back to the 0 line, so it has already achieved some pullback status. The price with respect to the river can be seen below, and right now it is resting on the upper shore of the river. The last couple times that it has rested on that north shore of the river, it has pulled back across the river to test the Z-1 level. It went through the Bollinger Band mean and back to Z-1. And on the basis of that analysis, we can say that a 3% pullback through the Bollinger Band mean to the south side of the river would not be unusual. That would be the least surprising move of all. So that's the downside targets that short-term traders should be planning for. To the upside, a move of 3 to 5% to the upside would be normal given the stability it's had for the last 10 days. It has paused to refresh. And so that's why I place the market in a critical state where a 3 to 5% move in either direction on a swing basis is reasonably available, which creates opportunities for short-term traders to take advantage of short-term volatility. That's everything I want to cover today. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.